Hey Fixedincome guys, so it's my second video on the mortgage market in the United States, and what we're going to talk about now, right, is the mortgage types that we have in the US. Right? So when you go, right, let's say in 10, in 5, 6 years, right, I hope that you will have families, okay, and when you have families or your spouse or your loved one, of course you want to have your own place, right? So you go to the bank. Hopefully hopefully you can buy with cash, but if you cannot buy with cash, right, you go to the bank and then you start negotiating. Okay, what do you want to get, right? So what I want to do now is to little bit talk about, okay, what kind of mortgage types we have in the United States when you go and shop for them. And the next video, what I'm going to do some calculations with fixed mortgages, so that you will understand, right, or you will remember how it is done, how we did it in class. So the formulas are very simple. You guys did it on the test, so you should be fine. Okay. So so when we talk about types of mortgages in the United States, we have the following groups, right? So first of all, we're going to talk about maturity of the mortgage. Then we're going to talk about, the size of the mortgage. And then we're going to talk about coupon type. Okay. So those three things, okay, define the type of the mortgage. Now, most of the mortgages in the United States, okay, are actually driven by a coupon type and a maturity. So the coupon type is fixed, okay, and your maturity is either 15 or 30 years, okay? And those guys, so the mortgages with fixed coupon, okay, and fixed maturity, are called conventional mortgages. So for example, when you go to the bank, right, to shop for a mortgage, okay, most of the banks, what they will offer you a mortgage with a fixed coupon. It means that you have a fixed payment every month. Okay? And with fixed maturities. And what are the most of the maturities in the United States? They're either 30-year or 15-year. Okay? Now, 30-year mortgage, okay, it means that if you are getting a mortgage now in December 2015, okay, the last payment of your mortgage will be in December 2045. When you are, if you are a young person, let's say you're 30, in 30 years it's going to be, close to retirement. Okay? So this is actually a very simple and very straightforward way of, the fixed income structure. Okay? So basically, you're paying each month, right? You're paying X amount of money, which will include the principal and the interest in the mortgage. Okay, we will talk about the next video how it is, the calculations, how it is done. Okay, and you're paying it on a monthly basis until you have it in December 2045. So when you want to buy a house, right? When you're coming to buy a house, let's say the house costs $300,000. Usually, what the bank will tell you, okay, can you please, Mr. X or Mr. John Doe, can you please put 20% down? Right? And the rest will be funded by us. Okay. So it means that you are going to get $240,000 mortgage with a certain coupon, right? The coupon is going to depend on your credit trustworthiness, or what we call, right, which is basically decided by the bank based on your credit history. That's why you need to have a good credit history, so that you want to get a low coupon. If you have a bad credit history, if you're behind your credit cards, if you're behind your loan payments, if you're behind your insurance payments, right, you're going to be penalized the next time that you're going to go and take a loan, right? And your coupon on your loans and your credit cards will be much higher, right? So you are getting $240,000 mortgage, right? Let's say with a certain coupon, let's say the coupon is 3%, right? The bank calculates the monthly payment. We are going to see how it is doing it next video, right? And then for 30 years, you're going to pay this monthly payment. So every year, right now, every year you're going to pay this payment. After 30 years, you're done. You're not paying anymore. Okay? So this is the most popular type of mortgages in the United States. It wasn't like this, right? In the older days, the mortgages were much shorter, and your down payment was not 20%, but it was much higher, right? So the affordability of housing was not as popular as it is now, right? It's actually very interesting to read the history, and I would actually encourage you to read about what the President Franklin Delano Roosevelt, what he did in order to reform the mortgage market in the United States, and how the mortgage market in the United States looked before prior to the 1930s, right? So it had, let's say, 50% down and a 5-year mortgage. And there was huge payments, and if you missed one payment, you were bankrupt. So it was much more brutal then. Okay, so it was reformed. So it's actually very interesting to see the evolution of these reforms. Okay, now this is one type of mortgages. Now there is another type of mortgages which is basically called ARM mortgages, ARM mortgages, which is basically a mortgage where you have, for example, 5-year fixed or a term, right? What we call the 5-year fixed coupon, and then the coupon floats. What does that mean in floats? Okay, so let's say first 5 years you pay 3%, tack, 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 tack. After 5 years, if you don't refinance the loan, right, and we will talk about refinancing in a minute, right? If you don't refinance the loan, right, what happens is that your coupon starts to fluctuate. So there are a couple of indexes, like a LIBOR index that we talked about, right? And then you have a LIBOR plus a margin, and depending on the LIBOR, right, the coupon is adjusted on a monthly, or usually it's adjusted on an annual basis, right? So let's say after 5 years, right, so you have first 5 years you have, let's say, 3% coupon, right? And after that, the 6th year, it will be LIBOR plus 225 margin, right? So if the LIBOR, let's say, is 0.25, right, you will pay only 2.5%. Okay? Now, these payments, sometimes, they vary. Sometimes they have only principal, only interest. Sometimes they include principal plus interest, right? So these kind of payments, okay, are actually, comes with myriad types. Now, this is less popular than this product. However, 10 to 15% of the mortgage market in the United States, well, maybe less, maybe 5 to 10, depends on whom you ask. Okay, and what kind of mortgages you include. 10 to 15% or 5 to 10%, okay, of those kind of mortgages, right, have this ARM, structure to it, right? So once again, the payment, right, and the coupon type can vary. The first 5 years is fixed coupon, and then the coupon starts to vary according to the LIBOR, right? So that's kind of the type, the types of mortgages that depend on maturity and the coupon type. Now, one trick question, right? So let's say that that you're buying a house and you do not want to stay in this house for more than 4 years. Let's say you want to buy a small house, but you have these things that you want to have, let's say 3 or 4 kids. You want to have a lot of kids, right? You know that after 5 years you will try to swap this house to a bigger house, right? Which mortgage you are going to take? Are you going to take the the 30-year mortgage or this mortgage, okay? So if you want to stay in a house for a short time, right, there is no point of getting those kind of mortgages, because usually those kind of mortgages, you know, they kind of, you know, the rate on this mortgages depend on 30-year rate or 10-year rate, okay, which is actually much higher, right, than a 5 or 3-year rate, which is here, right? So here your payments will actually be less than the payment here. Okay, so if you say, for example, you stay in a house, let's say for 5 years, and you say, okay, I know that I'm not going to stay in this house for more than 5 years, right? Then I'm going to take this, okay? Because, you know, I want to have kids, etc., etc., etc. Now, if you don't know, right, you may want maybe to consider this. Okay, maybe the payment's a little bit higher, but then, right, you have this, you know, peace of mind, right, that you don't, you know, you don't depend on those margins, you know, and interest rates after 5 years, and you're going to be, you know, entrenched in a, you know, in a payment schedule until the end of the mortgage. Okay. Now, one thing that we want to say is the size of the mortgage. Right? So the size of the mortgage matters, right? If you are going to get $240,000 mortgage, or you are going to get $1 million mortgage, right? It actually matters. Okay. I mean, we have this saying, right? If you own the bank, you know, $10, right? You have a problem. But if you own the bank $2 million, the bank has a problem, right? Because, you know, the loss of the mortgage of the loan in this case is actually very sizable, and it can affect, you know, the solvency of the bank, right? It can create a, you know, a confidence problem inside, you know, inside the other clients of the bank, if they know that, oh my God, there is a loan that, you know, the bank, you know, had to have, and it's suddenly defaulted. Okay? So in this particular case, right, we have this what we call a jumbo loan, which is more, I think, than $600,000 or around it. Okay, don't catch me, you know, don't catch me in the word, right? So those kind of loans are considered riskier than conventional loans, right? That loans that basically are, you know, securitized, because the agency do not securitize all the loans. They securitize only loans which they do not consider to be too risky. Okay, so for those loans which are not too risky, they actually securitize them. And jumbo loans are somewhat riskier, right? So then you have this kind of combination where some of them are securitized, but some of them actually are retained on the bank balance sheet, and that's where the, you know, lies the some issue, right? Because if they are retained, right, as a bank balance sheet, it means that the bank is going to scrutinize them much more closely. Okay? So, you know, that's kind of the bulk of the matter. That's kind of give you, I think, a decent picture of how, you know, of what kind of types of mortgages you have. And the third video in this series, right, I'm going to talk about a little bit about the math of the mortgages. Okay? So, that's it. Hopefully you enjoyed the video, and I'll move to the next one. Thank you and have a great day.